let's look at how our real estate market, how does the real estate market cycle affect real estate investment trust. So these are important things we must take into consideration. How real estate market cycle affects or influence or impact the performance of real estate investment trust. A real estate market cycle, which consists of periods of expansion, peak, contraction, as well as recovery, significantly influence the performance of real estate investment trust. The real estate market cycle, the entire market move in cycles is cyclical in nature, and so this cycle actually affects property values, rental income, as well as overall investment returns, which in turn will impact the performance of the real estate investment trust. So you need to know precisely, the nature of these cycles and how they impact the performance of REITs. Number one, we want to consider the expansion phase. The expansion phase here has to do with growth in demand and prices. Growth in demand and prices. So this will have a positive impact on rates. So during the expansion phase, property values rise and demands for real estate will also increase. So this leads to higher rental rates and occupancy level for properties owned by REITs. So as you have higher demand bringing higher rental prices, and that would suggest a positive sign that these companies are doing very well. You also look at increased income and dividends, because the growth phase will bring in increased in income as well as some dividends. So higher rental income drives funds from operations, allowing REITs to increase dividend payouts. Investors often benefit from rising stock prices due to growing cash flow, as well as strong property fundamentals. Discover that they will pay out more dividends. There's higher level of cash flow, and even the stock prices in the market will increase as well. This is a positive sign that you would will come across in the growing phase of the economy. When you look at the peak phase, that's a market saturation. We are through with the expansion phase, the growth phase. We want to consider the peak phase, that is market saturation. So in this case, you look at you experience slowing growth. So in the peak phase, the real estate market reaches its heights, in terms of pricing and demand. While properties may still generate income, rental grows slow, and new construction increases supply, which can dilute demand. You also consider potentially lower returns. You may experience potentially lower returns. So rates may face diminishing returns as the market becomes oversaturated, leading to increased competition for tenants and possible decline in occupancy rate. So equity rates might experience reduced capital appreciation as property prices stabilizes or decline. So you equally have dividend pressure. So the slower rental income growth may limit the REIT's ability to increase dividend payouts. So mortgage REITs will then also face pressure if interest rate starts to rise during this phase, leading to tighter margins in mortgage-related income. We proceed to the contraction phase. The contraction phase or the market downturn. So in this phase, there's a negative impact on rates. This negative impact on risk. And so during contraction, property value declines and demand for real estate falls. This can lead to lower rental income, higher vacancy rates, and declining assets values, negatively affecting equity risk, equity rates. So you equally have debts and interest rate sensitivity, debts and interest rate sensitivity. So rates, particularly mortgage rates, are sensitive to rising interest rates during this phase. So increased borrowing costs can reduce the profitability of mortgage-backed investments, and higher interest rates may also damper or may kind of dampened property demands, leading to declining property values. And then there's dividend cuts. Unfortunately, the company may experience dividend cuts. Investors may experience dividend cuts. So reduced income from operations and asset sales can force REITs to cut their dividend payouts. They may no longer generate sufficient income to distribute the required 90% of taxable income to shareholders. This could be quite unfortunate. So let's look at the recovery phase, that market rebound. We've considered expansion, we've looked at the peak phase, we've equally seen the contraction phase. We want to look at the recovery phase or market rebound. And this phase comes with opportunity for growth. So as the market begins to recover, property values rise again and rental income starts to increase. So REITs can benefit from improving occupancy rates, higher rents, and potential appreciation, of their real estate holdings. In addition, capital appreciation. So equity rates may see an increase in their portfolio value, as the market rebounds. So if they acquired, distressed properties during the contraction phase at lower prices, they could realize significant capital gain as the market recovers. Then we have gradual dividend increases. There's a gradual increase in dividend at this phase. So as rental income and asset value, grows, rates may begin to rise, to raise their dividend payout again. So investors can see a rebound in income, but the extent of dividend growth depends on how, how fast or how quick the rental income and property value recovers. So the recovery rates will determine, the dividend, increase rates. If the property recovers, quickly, then dividend will equally, be increased at a faster rate. It all depends on the pace of the recovery. So let's look at other factors affected, by market cycles. Other factors affected by market cycles. So there's an interest rate. Interest rate also, could be affected by the market cycles. So rising interest rate typically coincide with the contraction phase of the market and can significantly impact mortgage rates. So as their primary income comes from interest rate sensitive, this interest rate sensitive debts that tend to affect the industry, so it's something worth considering. So higher rates increase borrowing costs and reduces the value of existing debt portfolio, leading to lower profitability. So rates actually is very, very important. If the rates are high, it will increase borrowing costs. That will be paying, a higher amount of money as an interest rate, as interest compared to when interest rate is low. So you equally have demand and supply. Market cycles affect demand and supply. The supply of new construction can lead to market oversaturation during the peak and contraction phase. So rates that are heavily exposed to new development may experience higher vacancy rates and reduce rental income when supply exceeds demand. When the amount of real estate out there is so much, when the market is saturated, landlords will start, renting out their property at a reduced rental income, and that will eventually equally affect the nature of dividends that investors would expect to get. Then you have investor sentiment. Investor sentiment. So real estate cycle often influence broader investor sentiments. During expansion, rates are seen as strong growth opportunities, while in a downturn, they are viewed, more cautiously. This fluctuation in investor sentiment can lead to volatility in the share price of real estate stocks, companies related to real estate. So the market cycle is something we cannot afford to overlook, because it goes a long way to determine the value of real estate investment trust.